We have. I'm very pleased to introduce this second panel with our distinguished speakers. Again, you have seen their bios, so I will skip that part and go right into substance. I think Olivier Blanchard, the IMF chief economist, once said that policy coordination is a little bit like the Loch Ness monster. It's much debated but rarely seen in practice. And so let's add to the debate here, and maybe we can, with the insights we gain here, help to have more sightings of policy coordination. So right into it, policy coordination. Do we need it? Is there enough of it? And how do we get more? I think these are the questions, and we start, I would say, in the order of the printed in the panel. So, Rajat, why don't you take the microphone?
Thank you, Andreas, and thank you to ICRIER for inviting me for this panel. I might add at my request, I'd requested a change to this panel because it's something I have views on. Okay, I've been watching the G20 first as a UN official since 2009. And I think that in terms of macroeconomic policy coordination, there is one major unfulfilled expectation which the G20 on both sides, emerging and emerged, refuses to confront, which is that there is a politics underlying the possibilities of policy coordination. And that's an old politics, which maps into G20 space when you try and do more than tinker around the margins. I say that, I must context that statement. The G20 has done just about what it could do by not tinkering around the margins. They have achieved reasonable cooperation on base erosion and profit sharing. They've agreed broadly that certain types of fiscal consolidation should happen. And there it stops. What has now begun to happen, in my view, is in the framework working group, which actually India chairs with Canada, is a sort of, I'll use a rude word to provoke debate, a sort of zombie-like repetition of old central planning adages. The most ridiculous of which I find this idea that countries should, can, and will globally coordinate to deliver 2% global growth by producing laundry lists of what they're going to do to achieve that. Frankly, that's an insult to my intelligence and yours. That sort of central planning initiative was bound to fail because there is absolutely no theoretical or analytical reason for countries to meet at a bureaucratic level, commission papers from the IMF, the World Bank, and the OECD, and on the basis of such technocratic intervention, successfully secure 2% growth. And therefore, I mean, this is serious because this means there's a lot of dissimulation. I think patience, including mine, with the G20 is wearing thin, and it's wearing thin not because of anything else, but because the transition of the G20 from essentially a grouping of finance ministers and central bank governors, which it used to be, and that was a technocratic place with modest technocratic ambitions, to the hype produced by annual summits, is one in which there is an expectation that changes that require political action will happen. Otherwise, there is absolutely no point having summits, very expensive summits, as event management sort of opportunities where heads of state come and waste their time. And I think that's exactly what is happening now. It's boring. It is bureaucratically captured. And if this is going to change, I think as intellectuals, as policy people, we need to make the point that there are certain political issues that need to be addressed, which go beyond civil servants that manage the G20, because civil servants are not tasked to address political issues. So if the political impetus is not there, civil servants cannot deliver you through technocratic and bureaucratic negotiation the kinds of political change. So what are these political changes I'm talking about? I'm not talking about quotas in the IMF and the World Bank. That is a derivative of a larger political change, an acceptance that there is today an imbalance in global political economy that impacts, of course, developing countries and less developed countries, but they don't have a voice at the G20 table, but also impacts emerging economies in a profound way, and that imbalance needs to be addressed politically. If that imbalance, and things like savings investment imbalances, things like worrying about people accumulating reserves are symptoms of this fundamental political imbalance. That fundamental political imbalance, in my view, arises from the lack of access on market terms for emerging economies to three things they need. The third I will mention, I don't think the G20 can do anything about it. But the first two, I think the G20 could if they were willing to engage politically. The first is my field, lack of access to finance. Today, we are in a world where the demand for non-concessional finance, which is reasonably medium-term or long-term in nature, comes principally from the emerging economies. But the supply of that finance is contingent on unlocking, and this is an error people make very often, not the savings flows, which is what the focus of much literature has been on. I don't know if David Vines is here today, but he did focus quite rightly a couple of years ago in a paper I commend to you in the G20 context on savings flows, but on the historic stock of savings. That historic stock of savings, which is available for long-term investment, continues to reside in the pockets of the aging populations of the advanced economies, and is available in very limited measure, except on terms and conditions that make it very difficult to access it, to the emerging economies. I'm speaking here of long-term pension funds and other such long-term assets that are principally financed by legacy. Oil funds, another source of finance that is financed by legacy. So we have all these legacy finance saving stocks, not flows, stocks. And those stocks, in a low interest environment, a zero to low interest, real interest environment in the countries where they're generated, should logically be finding higher returns elsewhere, and they're not. Why? I have a theory, but I'll leave that for the discussion, because I'm not sure I'm right. But this is a fact. Those long-term finances are not moving. And yes? It would be interesting to hear the theory. Very well. In 2 minutes, I can tell you from, by example, the rating agencies are on the prowl again, and they come to see many of us in India. So this time I asked them a straight question. I said, we have low inflation, our fiscal deficit is under control, and we're the fastest growing economy in the G20. What's with your rating upgrade? So no, you have structural problems. So now the major barrier to access to finance is adjectival and structural. There are no metrics to this. You don't have good institutions. We are worried about regulatory risk. A very different world from the world in which you could prescriptively say that the three instruments of macroeconomic policy, if they were under control, demonstrably for a while, your exchange rate management was good, your current account was okay, your fiscal policy was okay, your monetary policy was okay, you would expect then to get increased access to finance, and credit rating agencies would signal that. They are not. So we're now moving into things like sociology and political science and the theory of institutions, which are gray areas, and therefore I argue this is fundamentally political. That's my theory, I could be wrong. All right, so that's access to finance. The second issue is access to technology and the rents accruing from things we want to do together to save the lives of our children. Simple example, we must all go solar. And wonderful things have happened with solar batteries, right? So for the first time, the possibility of moving to a largely renewables-based energy ecosystem is true, and countries like India should not stay dirty, and we should not burn coal, and we should take advantage of this opportunity. Yes, but pause for a second, and if you like, I'll tell you where to look. Look at the recent $100 billion SoftBank loan that India is getting from Japan. And don't look at what they're going to build. Look at when they are built, what will happen to the emerging profit streams. Between 25 and 30% of the emerging profit streams from the sale of that electricity, financed by these loans, will go to the providers of these new solar battery technologies. And they change as fast as iPhones. So this is going to be a repetitive process. 25 to 30% of that money, as first charge, is going to go back to the places where these solar batteries were imagined and conceptualized. And those happen to be Japan, Germany, France, and the US. And China, but China is not in this particular game, but these four. So what you're going to get then is a situation where to save the planet, rents from technology are going to go to finance aging in Europe and the US. I'm putting it deliberately provocatively. And clearly that's a political issue which will need to be confronted, and the only place you can confront these issues is the G20. The third one is access to capacity and access to institutions, but that's a broader issue. That is where the entire idea of global economic governance comes in, but I've frankly very much doubt that we'll be able to do much about that in the medium term. We will get ad hoc reforms in current institutions. You will then get second best attempts to start things like the BRICS Bank, to start rating agencies within the BRICS, perhaps in the emerging economies. It's the second best world. But it is not going to change because I don't think there is enough political incentive to attain a superior equilibrium on this front. So if we focus on access to finance and access to technology, which is a macroeconomic issue, because what we are seeking to address in macroeconomics now is also sustainability, then we have to realize that where we are intellectually, the G20 is one horrible step behind. We are still in the old world where we view the intentions of macroeconomic policy to be well-coordinated, effective fiscal, monetary, and exchange rate management. But my own country's example shows that well-coordinated, effective fiscal, monetary, and exchange rate policy will not deliver you the signal from global markets that you are open for business to a broader extent than before, which comes from the rating agencies. So, that being said, we have a political challenge. How could the G20, I have 3 minutes? How could the G20 address this political challenge? The first thing the G20 will have to do, which sounds pretty unglamorous, and I'm loath to say it with Andreas here, is this outsourcing of thinking to institute. It is as much a challenge for emerging economies, what I'm going to say, as it is for developed countries. There's no bad guy here. This is just political laziness on the part of our leaders and our bureaucrats. Who does the research for the G20? The IMF, at least I'm a member, although a highly unequal one. The World Bank, of which we are members, although highly unequal ones, right? The ILO in a small segment, an important segment, but a small segment, and the OECD, of which I'm not even a member. All G20 thinking is outsourced to these 4 institutions. This is peculiar in a grouping which should have ipso facto the capacity within the national boundaries of the member states to undertake collaborative research. As a policy intellectual, people like Rajat, me, Dieter, we interact all the time across borders, and we collaborate across borders. So the potential difficulty of collaborating across borders in the policy and intellectual space should be relatively limited to doing so with the flag on the table and discussions happening. But that is simply not happening. We do not have inter-country collaboration tasked by the G20 to deliver opinions on important analytical issues which could kickstart a political conversation. So I would submit that if the G20 became less lazy and less bureaucratically driven, and the good news is in the German presidency, I'm finding from early thoughts, Thomas is here, he can tell you more, a huge appetite to do this, which is very exciting. But it's not happened yet. It didn't happen in China, it didn't happen in Turkey, it didn't happen in Korea, and it certainly didn't happen, wherever they held these summits, I begin to forget now. So if we could do this, then I think the ability of countries to politically accept what is coming out of that joint work would be, I would conjecture, higher than coming out of institutions where there are already political tensions to accepting advice and a certain hesitation in believing, rightly or wrongly, that the advice is neutral. So one thing we should be doing is forming such knowledge consortia. The second thing I think we need to do in the framework working group is acknowledge that sustainable development is now, whether you like it or not, a macro issue. And the large investments that we seek to make in sustainable development for particularly energy infrastructure is something that should be discussed firmly within the framework working group, perhaps moving away from questions I love because I make a lot of capital out of them, like base erosion and profit sharing. I think we have reached the limits of what we can do in terms of international tax coordination learning in the G20. There may be things that we could do at the margin, and I'm fine if we do them. But I mean as a major focus agenda of the framework working group. That is not going to happen without some intellectual pressure, because the framework working group is run by finance ministry bureaucrats, and finance ministry bureaucrats are not primarily concerned either in terms of incentives or in terms of domain expertise about sustainability. But sustainability is a macro issue, and I think we will need to do some work to bring it on the framework working group table. And I say this particularly from a macro perspective, from a macro political perspective, because you cannot address issues of sustainability at a macro level without addressing the two access questions I discussed, as I gave you by example, access to finance and access to technology. So that's the second big thing I think we could see happening. The third thing that we could possibly contemplate, which is far more old-fashioned, and I'll stop there, is a relook at the possibilities for the G20 to promote within its context a sort of pooling of foreign exchange reserves and better coordination exchange rate management. But that would require a rather silent partner in the G20 to take on a much larger public role, which is the other thing I notice as someone who's been involved with this process since 2008, the steady diminution in the role of central banks in the G20. They are there, but they're doing things like Green Finance Study Group. They're not talking aggressively about exchange rate coordination and the possibilities for doing this. I could be wrong, and I'd be delighted to be corrected. But let me see, is there anybody here from the Reserve Bank of India? I rest my case. So that is a third area, and that would actually involve, paradoxically, unlike the first two, going back to the old-fashioned G20, recognizing that there was a reason why we had central banks and finance ministries on the table, that the traditional instruments of monetary policy, two of the three of them, monetary policies of macroeconomic policy and exchange rate management, involve both these players. And this relative silence on the part of central banks, which tend to be technocratic, well-managed institutions with good research departments, unlike most finance ministries, unlike my own, for example. But my central bank has better research capacity than my Ministry of Finance. So that could be put, I think, and they have a tradition of working non-confrontationally as well, and across political boundaries and barriers. So to conclude, what I'm trying to do here is, I'm being explicitly political because I believe that, as I said at the beginning, the time has come to be political. In that space, I can see three concrete areas where progress can be made. And the thrust of what I'm saying is, can we find institutions or collaborations within the G20 in each area where we can transcend the political barriers imposed by Westphalia and the traditional political barriers that divide emerging economies from developed countries? That will not happen on traditional macroeconomic terrain. And the proof of the pudding is we have tried it for 4 years, it's not worked. So if we can make this leap in imagination by bringing in the central banks on topic 3, which is an old-fashioned topic, by trying to build national consortia to argue the intellectual case for ways and means to improve access to finance, and by bringing a larger development issue on the macroeconomic table, the issue of sustainability, because it has global macroeconomic dimensions, I think that people will get far more interest in the G20 as anything other than an event management talking shop than it perhaps is now. Thank you.
Thanks, Arvind. As usual, thought-provoking intervention. We didn't expect less from you. And I expect more from the other side. So next online is Samran. Please go ahead.
Thanks, Andres. Good afternoon, everybody. Thanks, ICRIER, for inviting me to speak on this topic. And I think Professor Roy has set the stage very nicely and has taken part of the burden off me. I wanted to talk about 4 different things on macro coordination. At least one of the things I don't have to talk about, which Professor Roy has very nicely talked about. So the 4 different coordination areas to my mind, one is coordination in crisis times. Second is coordination to reduce global imbalances. Third is coordination to reduce unintended international spillovers of domestic policies. And the last one is what Professor Roy was talking about, which is managing or coordinating a sustainable growth agenda for the global economy. So since I have to talk less on the fourth, let me concentrate on the first 3. That too, I'm very happy that the first one does not require any time in saying that G20 was extremely successful in this, that coordination in crisis times really worked quite well. So let's move on to the second and the third ones and spend more time there. So the second one, if you look at it, which is coordination in times to reduce global imbalances. And in the earlier session, Andreas was referring to the MAP, the program to reduce global imbalances through a mutual assessment process. Now, what happened here was typically all the countries were asked to present their own forecasts on where they think things are moving. And agency like IMF, through an iterative process, was trying to see how global imbalances could be reduced if this is the plan that the countries think that they are following. So I would say that in the initial days, this was working quite well. IMF was able to identify 7 countries with some kinds of imbalances, and even was able to tell to some of them that what kind of policies you need to follow to reduce these imbalances. The challenges were, one is that this was a very cumbersome exercise, obviously, because different countries would be following very different kind of models. And obviously, IMF has a different model in the World Economic Outlook, so there is no necessity that the MAP and the WEO will match each other. And what happens then? Then the other problem is that what if the spillovers are occurring not through flows but stocks? There are studies which show that the multiplier effects could be between 2 to 5 times if you consider stocks of financial assets holdings rather than only flows of financial assets. Then there are asymmetric effects coming out from shocks originating in US versus shocks originating in the rest of the world. How do you manage those asymmetries? Then there is a kind of a lack of consensus on, is there a risk from abrupt unwinding of these imbalances, or is it just a persistent problem which we will have to live with? And then I think the most interesting bit is that somewhere around the European crisis time, G20 seems to have thought that this is not the most important problem anymore. There is something else that we have to deal with. And in a quite hushed way, this exercise has been kind of put into the back burner, and we have moved on to G20's role in other areas like supporting Europe, or now into more growth-promoting policies. And also, this MAP exercise has this whole issue of whether if one country adopt a particular policy, what's the guarantee that the other country will also adopt this similar kind of policy? What will be the enforcing mechanism there? So these were all very tricky issues, and that's why probably we did not achieve as much as we would have probably wanted to achieve out of the MAP exercise. But the fact that even at a global level, we were able to conceptualize something of this magnitude, to my mind, it's a non-negligible achievement. Let me move on to the third topic, which is the most important or interesting one to me as a student of economics as well as a market participant, which is containing the unintended international spillovers of domestic policies. And the traditional view is actually quite simple, that even if one particular country is following either a conventional or an unconventional stimulus, the mechanism through which the other country's economy will adjust is the mechanism of exchange rates. And if the exchange rate is allowed to move freely, then conventional or unconventional monetary policies should not have much of an impact anywhere. Except for the fact that whether a country lets its exchange rate adjust or lets the interest rate adjust, depending upon that, the impact will be on either the tradable sector of the economy or on the non-tradable sector of the economy. So the only choice in front of the policymakers seemed to be a political choice of how to balance between these two sectors, rather than being worried of the conventional versus the unconventional monetary policy. But over time, I think these issues have been researched further, and one of the classic papers of Helen Ray clearly identifies that the spillover effects are much stronger than what the theory would suggest, and even within the flexible exchange rate framework, there could be material impact on the economy in zero lower bound interest rate cases and in cases of capital market imperfections. And somebody like Governor Rajan has argued that the countries who allowed more flexibility in exchange rate actually have been whipsawed in the action, where initially the exchange rate appreciated too much, and when the taper shock came in, the depreciation was also too much. So it's theoretically, this proposition has been challenged now, that whether the whole idea of flexible exchange rate taking care of the unintended spillover effects, that's right or wrong, even on a theoretical sense. And then comes the whole issue of the coordination games that Frankel talks about, both from the fiscal side and the monetary policy side, where on the fiscal side, you either have a choice of a locomotive game, which is kind of expansionary fiscal policy world over, and or you have a discipline game where everybody is going into fiscal austerity. Now, both these are kind of a Pareto improvement over the alternatives. But the challenge is that both for fiscal side as well as for monetary policy side, there does not seem to be any unanimity among the world leaders about which is the right game to play. In particular, if you look at the monetary policy side, you have a similar problem where you have one effect of expansionary monetary policy which can come from a demand switching perspective, which works primarily through the exchange rate channel, and the other is a demand creating variety where the expansionary monetary policy will probably generate demand for foreign goods, and through that the trade balance of the foreign country can actually improve. So these are two opposite effects of expansionary monetary policy, and one does not know that the net effect, whether it's adverse or not, and if it is adverse, how large that net adverse effect is of expansionary monetary policy. So because of these challenges in finding out what's the game that we are playing, it's not even sure that what rules to set, because if you don't know the game, how do you decide on what rules to set? So given this context, I think the reason why this unintended spillovers have suddenly become a very topical issue is Governor Rajan being extremely vocal about this, and here I would probably disagree with Professor Roy a little bit that central bankers for a change have been talking quite vociferously, or some of them have been talking quite vociferously about having a more coordinated approach to monetary policy making, right or wrong. So if you look at Rajan's argument, it's basically twofold. The first argument is that if you have an unconventional monetary policy in, say, US, a foreign country, then it's quite likely that as a response to that, an emerging market currency will be tempted to follow a path of expansionary monetary policy, depreciation, blah, blah, blah. Now, that's one level of the argument. If everybody is following the same strategy, then it's that beggar thy neighbor attitude, which will be Pareto suboptimal. The other argument that he is making, and which is connected to what we were discussing about the safety net argument, is that maybe this additional flows emanating from the foreign country to the emerging market might lead them to kind of get so much of FX reserves that that's also a suboptimal outcome. So maybe if you have a safety net, then the necessity to have those kind of higher reserves is less, and you are in a somewhat of a better outcome. So initially, I think Governor Rajan suggested something which was a much weaker coordination approach, which was only two things, which is that the central banks should take the spillover effects into account, and second is creating the safety net. But more recently, if you look at his paper this year, I think he is suggesting something which goes way beyond a weak coordination, where he is suggesting that the rules of coordination has to be kind of rated. Every policy has to be rated red, green, and orange, depending upon whether it's enough coordinated or not, whether there is enough adverse impact or not. So get to that kind of rating. The things that he is suggesting, one is that the net adverse spillover effects of that policy should be very limited.